there's a big elephant in the room. And that big elephant is the federal government. And between the DEA and the IRS, there are some real complications in this industry. The dark side of it is not having a bank account, bringing satchels of cash to the Department of Revenue to pay your sales tax, to have the IRS maybe audit you, that could be a real problem. Or what do you do when someone calls you and says, the DEA just launched Operation Shatter in Washington and they're arresting extraction artists? So if you're faint at heart, or you don't think the possibility of spending time in a penitentiary is an ordinary and acceptable business risk, then you might want to think twice about this. I'm not trying to say don't do this or do it. Like I said, I'm close to it. It's exciting. It's a new field. Things are getting better. The federal government's moving along a little bit. So things are getting better. But what if there's a new president? What if there's a new attorney general that's not so favorable? So still a very, very murky situation. So back in 1913, we passed the 16th Amendment to the Constitution, which created an income tax very much like the one we know now. And in 1916, the Congress codified it. And one of the intents, and when we look at doing consulting for you on the accounting and tax side, we're kind of looking at what is the IRS code, what are generally accepted accounting principles, what is congressional intent, and how do we manage your business model to maximize your tax scenario. And so then congressional intent's very important, and congressional intent back then was basically, we're not passing a tax code to punish wrongdoers. Everybody needs to report their income and pay their taxes, whether it's legal or illegal. And people shouldn't be taxed on money they don't have, so their costs should be deductible. And that went on for quite a while. Section 61 of the code says that you have to report your gross income from whatever source it's derived. And also then Section 162 is saying that you should be able to deduct ordinary and necessary business costs. And this was the law, and the courts upheld this for a long time. And then in the 1980s, there was a case of a cocaine smuggler, and it turned out to be Edmondson versus the commissioner. And just as the intent of Congress had been and the case law had supported, the commissioner and the courts allowed Edmondson his ordinary deductions. He deducted the cost of his scale. He deducted the cost of his packaging, his shipment. Well, this upset the Congress. And so the Congress said no. They said, we're going to pass a law, 280E, and this is your IRS elephant in the room. And 280E basically is saying that cannabis is a Schedule I narcotic along with heroin and cocaine, and that you should not be allowed to deduct your ordinary and necessary business costs. And what was their rationale? Well, their rationale was that there's a public policy here, a public policy against drug trafficking, and because people, or the taxpayers, are spending billions of dollars on a war, it makes no sense in letting drug traffickers get away with deductions in their taxes. So that's kind of where we were left with 280E, and where do we go from there? Well, there are a couple of avenues that we can take that kind of gives us a little shelter from 280E. There's a constitutional concern. The Congress, as a matter of fact, the Senate report back in the 80s when the senators that drafted 280E said really the most important part of that is to preclude possible challenges on constitutional grounds, the gross receipts with respect to effective cost of goods sold should not be affected by this bill. So what they're saying is that back at that congressional intent that we talked about, saying that people shouldn't be taxed for money they don't have, they're saying basically the deduction that you're allowed is your cost of goods sold. So that is one avenue that we go down in order to maximize your deductions. And then there are others as well that we'll talk about real briefly, such as segregation of your business model, caregiving separate from from dispensary functions and so forth. Now there was, let me back up a little bit. Because the IRS is not very friendly and their audits so far are taking away as much deduction as they possibly can, what we're doing is we're really relying on court cases and legal precedent. Because the IRS is denying certain things, we go to court, and sometimes we have a favorable ruling and sometimes we don't. In the case of CHAMP is an excellent model for how to put together your dispensary and your business and maximize your deductions. Number one, the court ruled in favor of them deducting their cost of goods sold. And then number two, the court ruled in favor of them segregating those business functions. And originally they were being slammed, I think, with about $400,000 in taxes that the IRS was disallowing deductions, had $400,000+ in taxes. By the time they went through the hearings and the court case, the judge had allowed them their cost of goods sold. The judge had allowed them a lot of deductions for segregating their business. This is just the cost of the gross income segment. I put that up there. You could just glance at it a little bit. But they had about $1 million worth of revenue, and this was their cost of goods sold, which was allowed. And it left them down at the bottom with about $212,000 of revenue. By the time they got through with all their operating expenses, they had $439 in gross net income. So you can see quite the discrepancy there between their position and the IRS's position. Well, by the time the courts got done, it was a whole different story. And by segregating their services, and this is important because this is right out of the court case, and this will tell you a little bit about, well, what is segregating your business? What's acceptable? And you can see there, and I won't go through the whole thing, but you know, they did a lot of caregiving. They had social events, field trips. They did a lot of HIV counseling. They had a separate location that was just caregiving. So the courts saw all of this as acceptable and within the statutes, and they granted them those cost of goods sold. They also granted them the segregation of business, and by the time they were done, they owed about $4,800 in taxes. So we look at CHAMP as a very, very successful model. Now there's Oliver versus the commissioner, and this is how not to do it. And I'll go through this really briefly, but basically, Oliver was a kid out of college, I believe in Colorado. He wanted to start a dispensary, and some of his friends joined in, and they had a dispensary, and basically it was just, you know, they sold pot there, and everybody came in and got high, and you know, it was a big party. Well, then he got called to task by the IRS. He was so discreditable as far as being able to claim anything as far as segregation of business functions. The court disallowed all of that. His records were so bad that his cost of goods sold was so low that it was unreasonable. The courts actually imputed a 75, or I think 72.5, I have it down there, % cost of goods sold, which was much higher than he was claiming because his records were so bad. But because his records were so bad, he really just lost the battle and paid a lot of fines and a lot of tax. And this is really a model that we look at as how not to do it. There are other cases. Harborside, the federal government is telling them they owe a couple of $1 million in taxes. That's been stuck in the courts. That's a big case for cost of goods sold because they've used a more expansive cost of goods sold definition. It's section 263A, which goes into a lot of very indirect costs that you can attribute to your cost of goods sold. And so far, IRS audits are disallowing it. So the courts, again, we'll look towards the courts and see what they do for us. Entities, I'll go into that very briefly. You know, everybody, the question I get most often is, what kind of an entity should I be? Should I be an S-Corp, an LLC? Should I be a nonprofit? And, you know, you could be a Schedule C sole proprietor or a Schedule F if you're farming. A C corporation, I wouldn't necessarily recommend, but there might be tax reasons for it, and that's something that would take some real thought. I'm not typically a big C Corp fan. And then the nonprofit mutual benefit corporation. There are some states, like California, that say that their business is nonprofit. But the bottom line is we really don't know what Florida is going to look like, what the rules that they promulgate are going to look like. And one of my favorite pieces of advice to give people is hurry up and wait. You know, don't spend a ton of money doing things that, you know, in another 5 weeks from now or in another 6 months from now after rules have been promulgated, you're going to find out that did you no good. So we're all kind of in that state of flux. But the one thing I would say, regardless of what entity that you might claim to be, right now, unless things change a lot, unless 280E is repealed or something amazing happens, it really doesn't matter too much on the federal level. You know, you're going to get taxed, you're going to get a lot of your deductions disallowed, and so you have to be really careful. You have to be careful about how you do your books, about the deductions you take, your rationale for them, how you create your business model, what kind of, you know, functions are there, and are they sufficiently segregated. So these are the kinds of issues that we're looking at and developing day by day. It changes every day, and as the court cases come, we're just being as agile as we can and do the right thing.